All right. Today, we're going to break down a single, absolutely massive $32 million bet made by one of the big players. And stick with me, because by the end of this, you're not just going to know what they did. You'll get the why. You'll see exactly how they turned market-wide fear into a strategic advantage. And that's a playbook anyone can learn from. Okay, let's just dive right in. This number, $32 million. That's the size of a single bet on one company, Boston Scientific. But here's the thing. This was not a simple gamble, not even close. It was an incredibly sophisticated, calculated move that tells us a whole lot about their view on the company's future. So, what's the first thing you think of? That they were betting the stock would just shoot to the moon? Well, not exactly. The really smart part here is that they could actually make money even if the stock went sideways, or even if it dropped a little. So how is that possible? Well, it all comes down to a really clever play on three key things: raw market fear, cold hard probability, and, believe it or not, just the passage of time. So let's get into the nitty-gritty. This is the anatomy of the trade. What they did was they sold 4,000 put contracts. Now, what does that mean? It just means they made a deal. They agreed to buy Boston Scientific stock at $80 a share. But here's the catch, and it's a big one. They're only on the hook to buy it if the price actually drops below $80 by April of 2026. And get this, just for making that promise, they collected almost $500,000 in cash right up front. Okay, so to really get to the bottom of this, to understand the genius behind it, we're going to treat this like a financial detective story. We've got 6 key clues that are going to help us crack the case of this massive $32 million bet. All right, clue number 1. And this one starts with a little bit of chaos in the market. A huge company announcement kicked up the perfect storm, which for a smart trader also means the perfect opportunity. So here's the play-by-play. That morning, bam, Boston Scientific drops a bombshell. They're buying a company called Penumbra for a whopping $14.5 billion. And what does the market do? It freaks out. It's a total knee-jerk reaction. Investors see that price tag, they start worrying about all the new debt, and they just start selling. The stock drops 5%. And it's right there, in the middle of all that panic, that our trader makes their move. Now, this is where it gets really interesting, because the trade itself was specifically designed to make money from that fear. See, this isn't about having a crystal ball and predicting the future. It's about monetizing the anxiety that everyone else is feeling. The specific tool they used is called a short put. It sounds complicated, but the idea is simple. By selling this thing, they got an immediate cash payment. And in return for that cash, they made a promise. They promised to buy Boston Scientific shares at $80. But, and this is key, only if the stock actually crashes below that price by the expiration date. You know, the easiest way to wrap your head around this is to think of it like an insurance policy for a stock. This trader looked at all the panicked investors and basically said, hey, you're all scared? Fine, I'll sell you some insurance. You pay me a fee right now, that's the premium, and I'll guarantee that if your stock tanks below $80, I'll be there to buy it from you. They're literally selling fear insurance. And this is what gives them such a massive edge. Look, if you just buy the stock, it's pretty much a 50-50 shot, right? It goes up, you win. It goes down, you lose. But with this strategy, they win if the stock goes up. They win if it stays exactly the same. And they even win if it drops, as long as it doesn't drop below their $80 line in the sand. When you run the numbers, this trade had a built-in win probability of over 85%. That's a huge statistical advantage. Okay, but a bet this big isn't just about the math. You would never, ever make a move like this unless you had deep fundamental conviction in the company itself. Because what if you're wrong? You have to be perfectly happy to actually own the stock at that price. So let's take a look under the hood at Boston Scientific. First off, let's be clear. This is not some slow, boring company. Boston Scientific is on fire. It's growing at over 15%. I mean, that's just crushing its competitors. They're not just meeting expectations, they're blowing past what even the Wall Street analysts thought was possible. When a company has that kind of momentum, it's like a powerful wind at its back. And remember that big acquisition that had the market running for the hills? Well, the smart money saw a completely different story. They didn't see debt, they saw a brilliant strategic move. They saw a company buying its way into the single fastest growing part of their industry, adding over $1 billion in revenue and getting their hands on the best technology out there. The bet was simple. The long-term win from this deal was going to be way, way bigger than the short-term price tag. So how did they know the odds were so ridiculously stacked in their favor? Was it just a gut feeling? No way. This is where the math comes in. It all comes down to how these options are priced. And we can understand it by looking at just a couple of key data points that traders call the Greeks. Okay, there's this metric called delta, and you can basically think of it as the market's vote on probability. At that moment, the delta was telling our trader that there was only about a 15% chance of the stock falling below $80. So if you flip that around, the market itself was saying there was an 85% probability that this trade was going to be a winner. But wait, there's more. They also cashed in on something called Vega. Now, Vega just measures how much an option's price changes when fear in the market goes up or down. And because of that big acquisition news, fear was through the roof. We're talking the 82nd percentile, which is unusually high. So they sold their insurance policy when the price of fear was sky high, betting that eventually everyone would calm down. As that fear disappears, the option gets cheaper, and that's pure profit for them. And that $80 price point, that wasn't just some random number they pulled out of a hat. No, that was a carefully selected line in the sand. Think of it like building a fortress, designed to withstand just about anything the market could throw at it. I mean, for this trade to actually lose money, the stock would have to go into a complete freefall. It would have to smash through multiple major support levels that all the big institutions are watching. We're talking about breaking below the 50-day moving average, crashing through the 200-day, and even falling below the lowest price it had hit in the entire last year. That $80 level, it really was a fortress. So what can we learn from all this? When you step back and look at the whole picture, it all comes down to a really simple but incredibly powerful playbook. It's the kind of thinking that some of the best investors in the world use day in and day out. And you know whose philosophy this echoes perfectly? The one and only Warren Buffett. This is literally his playbook. He famously said you should identify a wonderful company and then basically offer to buy it at a fair price by selling a put. If the stock never drops to that price, hey, you don't get to buy it, but you get to keep the money you were paid for the offer. It's a classic win-win. So here it is, the 4-step institutional playbook. Step 1, find a high-quality, growing business you actually believe in. Step 2, be patient and wait for the market to panic about something. Use that overreaction as your entry point. Step 3, sell that volatility. Collect a fat premium when fear is at its peak. And step 4, set your price. Pick a strike price that's such a bargain, you'd be absolutely thrilled to own the stock there. And really, that's the whole secret, isn't it? That's the masterclass behind this $32 million trade. The smart money knows how to turn widespread anxiety into a high-probability bet. So it leaves you with a question, right? The next time you see fear gripping the market, what are you going to see? Are you going to see risk, or are you going to see an opportunity?